Did you know that even the most financially aware individual can make financial blunders? And this is okay. Sometimes it might be beneficial to review your financial situation to make sure you aren't unintentionally overpaying on things you don't need or delaying any financial obligations with due dates. Hello everyone, welcome back to my channel. Today's video will feature the top 10 financial mistakes to avoid in 2023. But first, if you haven't already, please subscribe to my channel and enable the notification bell so you can see more interesting videos like this. Calculating the amount of money you need to earn, save, spend, and invest to achieve your life objectives is part of the financial planning process. A financial plan provides your life direction, helps you make wise financial choices, and gives it purpose. Create your financial objectives. Now, as the new year is the time for resolutions. Without financial preparedness, a New Year's resolution is frequently unfinished, since doing so might end up being expensive in the long term. Here are the top 10 financial management blunders to avoid before the new year. Number 1. Investing without a specific goal. People frequently invest without a clear goal in mind and do so only to reduce their tax liability or maximize earnings. When investing, one must consider its intended use. Number 2. Long-term non-monitoring of the credit report. Many people, even those who are knowledgeable, plan to check their credit history until they are applying for a loan or credit card. How often do you review the statements from your credit cards? It's usual to scan a statement to see the entire amount owed or to opt not to read it at all and leave the payment process to automatic payments. However, those that thoroughly go over their credit card accounts each month can discover they can avoid frequent blunders in money management. Cutting back on purchases of services you almost ever use, or identifying duplicate charges you did not initiate and informing your credit card provider are a few examples of these. Since it displays what factors have increased or decreased your credit score over the past year, you should check your credit report frequently. Number 3. Missing payments on the due date will hurt your credit score. This includes failing to make credit card and EMI payments. Not automating bill payments is not always a bad decision. Instead, it is a recommendation that can assist prevent bill payers from incurring costly errors like forgetting to submit a check or pay a bill by the due date. Automating financial choices does a little more than just make sure you meet deadlines. From planning payments to putting aside a portion of your money for retirement, it could enable you to cut costs. Let's imagine, for illustration purposes, that you have a certain amount deducted from each paycheck. Through the use of an automated contribution setting, you directly deposit money into an investment fund, such as a low-cost index fund. You are investing money in the stock market, regardless of what happens there. Accepting automation entails more than just putting up contributions and moving on. Over time, automation enables people to use dollar-cost averaging and accumulate substantial wealth. Your creditworthiness may be impacted, making it more challenging for you to borrow money in the future. Decide to maintain your payment discipline in 2023. Number 4. Using an excessive number of credit cards. Avoid using an excessive number of credit cards to pay off one line of credit. If you apply for many credit cards in a short period, managing multiple cards can be challenging, can result in overspending, and can lower your credit score. Number 5. Inability to strike a balance between debt, savings, and investments. It is smart to start by prioritizing the necessary payments and making them one at a time. Pay off considerable debt while making tiny savings contributions. Choosing to invest when you have extra money is another option. The simple line is that paying off your obligations on schedule is just as crucial to your financial future as saving and investing. Number 6. Don't undervalue the power of compounding. One of the fundamental principles of creating money is the power of compounding, which a lot of people ignore. Essentially, compound interest is the process of gaining interest on interest while keeping your money in the bank. Long-term returns from the invested funds will include both the capital invested and the earnings that were accrued. Number 7. Ignoring insurance when making financial plans. A sound financial strategy involves insurance. Do you currently have a regular or Roth IRA? You still have until 2022 to make the maximum account contributions. Anyone under the age of 50 may make annual contributions to their account of up to $6,000. Those over 50 may increase their catch-up payments by an additional $1,000 each year. While it's not necessary from a financial standpoint to max out your retirement account each year, doing so is strongly advised if you have the means to do so. This also applies to any employer-sponsored retirement programs that you could take part in at work. By filling up these accounts to the maximum, you may let your assets and any prospective returns increase tax-deferred. To guarantee that you can still accomplish your goals in the case of a financial crisis, it is crucial to be ready for the unexpected. You may safeguard people who depend on you financially by getting life insurance. Number 8. Making retirement plans without taking inflation into account. Due to the present high rate of inflation, many people are concerned that their savings will continue to depreciate as prices increase. Make sure you're saving enough against the retirement you want by reviewing your budget to discover where you might need to cut back on your expenditures. Number 9. Emergency funds are crucial yet underutilized. It is more important than ever to have an emergency fund. Having more money taken out of your paycheck on top of all your debt may be painful. An emergency fund may be a lifesaver in situations like these when worries about economic instability and job losses are on the rise. Number 10. Lack of comprehensive analysis due to pressure to invest quickly. As the year comes to a close, you could already have run out of the opportunity to make tax-saving investments, and you might not have time to thoroughly weigh your alternatives. Your money will have more time to grow if you invest at the start of the year rather than putting away a significant quantity all at once. I'll add this. Maintaining old financial goals. When they initially begin a budget, the majority of people set financial objectives and diligently attempt to achieve these goals in accordance. Check in with your financial targets now. Have any of these objectives, such as needing to pay off credit card bills, have you lately attained? Do any of your financial objectives no longer apply to your requirements and circumstances? Review your current financial objectives. Reassess the importance of each objective. Make a point to create new financial objectives that are in line with your life changes if you discover any of them are no longer applicable or you've already achieved them. With that stated, it should be clear to everyone that it is good to build your financial planning on both short and long-term objectives. Improve your grasp of finances, assess current financial arrangements, and match your plans with them to make wise financial decisions. If you enjoyed this video, don't forget to hit like, the subscription button, and the notification bell to get notified when new videos are uploaded from our channel. Do well to share your thoughts in the comment section. See you in the following video.